Imagine facing a significant shift in the way discretionary trusts are taxed across Australia. From July 1st, 2028, a new minimum tax of 30% will apply to discretionary trusts, aiming to better align trust income tax rates with those paid by workers. Why this change? Discretionary trusts have long allowed for income splitting, where trustees allocate income to beneficiaries with lower marginal tax rates. This has created opportunities for high-income individuals to pay less tax than wage or salary earners at equivalent income levels, undermining the progressivity of the tax system. Under the new rules, trustees will pay a minimum tax of 30% on the taxable income of the trust. Beneficiaries must still report trust distributions in their income tax returns, but a non-refundable tax offset will reduce their liability, ensuring no one pays less than the minimum threshold. However, this offset can't be used to reduce the Medicare levy, nor be refunded or carried forward if it exceeds an individual's taxable income. Not all trusts or income types are affected. The minimum tax excludes fixed trusts, charitable and testamentary trusts, complying superannuation funds, and certain income relating to vulnerable minors or foreign residents. For example, primary production income and distributions to charities remain outside the scope. Testamentary trusts offering genuine benefits to families will also be exempt, provided income is linked directly to assets from the deceased estate. Let's consider practical examples. If individual A is the sole beneficiary of a trust's $200,000 taxable income, the trustee pays $60,000 in minimum tax. Individual A receives a $60,000 offset, but after normal tax calculations, any surplus offset does not cover the Medicare levy. Corporate beneficiaries, meanwhile, cannot use the offset, supporting the integrity of the system and preventing trusts from passing on minimum tax benefits as refundable franking credits. For those impacted, the government will offer expanded rollover relief for 3 years, starting July 1st, 2027. This lets businesses restructure from discretionary trusts into other entities, like companies or fixed trusts, without immediate tax consequences. The relief is broader than previous rollover measures, encompassing more asset types and allowing family units to retain economic ownership through transition. Restrictions prevent relief where outcomes remain essentially discretionary, ensuring the spirit of reform is respected. Trustees must pay attention to the treatment of excess franking credits. The government is weighing whether to refund excess credits or allow them to be carried forward, each with implications for compliance and integrity. Stakeholder feedback will be essential here. What would make administration simpler and fairer? Implementing the minimum tax will bring new notification and collection responsibilities for trustees. They must inform beneficiaries of entitlements and offsets, while the Commissioner of Taxation will have expanded powers for collecting tax from trustees, including corporate trustees. Directors may be held jointly liable to ensure compliance. A landmark High Court decision, Bendel, has clarified the treatment of corporate beneficiaries' unpaid entitlements, and the consultation paper welcomes views on how this interacts with the new tax measures. So, what does this all mean? The reform seeks a fairer tax system, balances complexity with clarity, and provides mechanisms for transition. Now, the government invites your feedback. How should discretionary trusts be defined for tax purposes? Are new collection and notification requirements workable? Is the treatment of rollover relief and excess franking credits suitable? Your insights will help shape how these important changes are implemented. Submissions are open until July 31st, 2026. Whether you're a taxpayer, business owner, or advisor, your voice matters. Engage confidently, knowing Australia is working towards a clearer, more equitable tax landscape.